Imagine getting a letter in the post with the HMRC letterhead on it, asking you to explain every single line of your tax return from the last 3 years. This isn't some hypothetical nightmare. In 2026 alone, HMRC opened hundreds of thousands of compliance checks against the nearly 12 million self-assessment returns filed in the UK, and a huge chunk of them started the exact same way, a number that didn't match what another source had already reported. If you live in the UK, run your own business, have a side hustle, rent out a property, or simply file your tax return every year, the next few minutes could be the difference between staying under the radar and landing on top of HMRC's review list. Because what most people don't realise is that the overwhelming majority of investigations aren't random. They're triggered. And today I'm going to show you the 5 signals that are most likely to catch HMRC's attention right now in 2026, with real examples and numbers that will make you look at your own tax return in a completely different way. Before we get into the 5 points, let me give you some quick context because it changes everything. HMRC stands for His Majesty's Revenue and Customs, and it's the UK's tax authority. And contrary to what a lot of people assume, the word audit isn't actually how HMRC refers to the process. Over here, the official term is compliance check or inquiry. But the effect is the same. Someone from the tax office is going to knock on your door, or rather land in your mailbox, asking for documents, bank statements, receipts, and you're going to have to prove that everything you declared is true.
And the reason this matters so much right now, in 2026, is that HMRC has never had this much information about people's financial lives before. It cross-references data from banks, from the land registry, from employers, and since the start of this year, it's also automatically receiving data from digital platforms like eBay, Vinted, Airbnb, Etsy, and even delivery apps like Just Eat. That means if you sell something online, rent out a room, or pick up gig work through an app, and the amount you received doesn't match what you declared, HMRC's system, called Connect, has probably already flagged that discrepancy before you even noticed it yourself.
So let's get into the first red flag, which is without a doubt the most common one of all. A mismatch between what you declare and what third parties have already reported to HMRC. Think about it this way. Your bank reports the interest you earned. Your employer reports your salary. A platform like Airbnb reports how much you made from hosting. And now, under the new OECD rules that came into effect for reporting digital platform data, if your gross income from online sales goes over £1,000 in a tax year, you need to declare that through self-assessment, even if your actual profit was much lower. Notice that this £1,000 figure is based on total income received, not profit after costs are deducted. This catches a lot of people off guard because their instinct is to think, well, I barely made any real money from this. But for HMRC, what matters at this first filter stage is gross income. And there's a real case that illustrates this well. A teacher in Manchester who was giving private tutoring lessons as extra income was flagged by HMRC through her bank data because the recurring deposits into her account didn't match any declared source of income. What started as a small oversight turned into a full compliance review. The same applies to anyone with rental properties. HMRC cross-checks public land registry data against self-assessment returns, so an undeclared second property generating rental income is one of the most obvious and easiest to spot red flags out there today. Now, before I get into the second red flag, think about this. If even a teacher giving private lessons got caught through data matching, imagine what happens to someone running an entire business on cash. And that's exactly where the second point I want to show you comes in.
The second red flag is businesses that operate heavily in cash. Sectors like construction, hospitality and restaurants, taxi drivers and beauty salons have always sat at the top of HMRC's priority list, and the reason is easy to understand.
When most transactions happen in cash, it becomes far harder to track the real flow of income just by looking at a bank account. So HMRC tends to pay closer attention to this type of business, comparing the declared profit margin against the sector average. If a restaurant in a given area typically reports a gross profit margin of 60%, but your business, in the same trade, in the same city, is declaring a 25% margin year after year with no plausible explanation, that raises the obvious question: where is the undeclared money going?
This doesn't mean every cash-based business is doing something wrong. Far from it. But it does mean these businesses automatically fall into a higher risk category, and any inconsistency in the numbers is going to attract attention much faster than it would for a business that only takes fully traceable digital payments. And there's another angle to this same issue that tends to catch business owners off guard, even small ones, using the company account as if it were the owner's personal account. This happens when a director repeatedly withdraws money from the business without it being properly recorded as salary or as a formally declared dividend. This mechanism even has a technical name, a director's loan account, and the rule is clear. If the balance a director owes the company goes over £10,000 at any point during the year, it's treated as a benefit in kind.
And if that amount isn't repaid within 9 months of the end of the company's accounting period, the company has to pay an additional charge of over 33% on the outstanding balance. The reason this is one of the easiest red flags to spot is simple. All of this is recorded in the company's statutory accounts, so the paper trail is right there in plain sight for anyone reviewing it, with no extra investigative effort required. Which brings me straight to the third red flag, closely connected to the second one, but this one also catches people who are self-employed and operating in a completely legal, transparent way. Expenses that are disproportionate to declared income. This is one of the quietest triggers out there, because a lot of people don't even realize they're falling into it.
Here's how it works. HMRC has fairly well-defined benchmarks for how much it's reasonable for a business to spend, proportionally, depending on the sector. If you're self-employed and you're declaring expenses that represent, say, 80% or 90% of your revenue year after year, that's statistically unusual, and HMRC's system, which now uses AI-powered tools to spot anomalies faster than ever, is going to flag that return for a second look. There's a very specific real example that comes up constantly in the practice of UK accountants. The owner of a small craft business in Leeds, who also had a full-time job on the side, declared a loss in her craft business for 3 consecutive years, totaling £18,000 in losses, while keeping her main job.
HMRC opened an inquiry because in some of those years, the declared loss was bigger than the business's own turnover, which raises the question: is this still a genuine business with a real profit motive, or is it just an expensive hobby being used to reduce the tax paid on the main job? And this is an interesting point because HMRC literally has an internal guide to help tell the two apart, looking at factors like how regular the operations are, the scale of the business, and whether there's genuinely a commercial intent behind it. Recurring losses on their own aren't illegal, and plenty of people have legitimate losses while building a business from the ground up. The problem is when the pattern repeats year after year with no evidence of a real growth plan behind it.
And there's a detail about this third point that almost nobody mentions. HMRC doesn't just look at the absolute value of expenses, it looks at the proportion, the history, and the context of the entire sector. In other words, 2 self-employed people could have exactly the same amount of declared expenses, and one of them never gets questioned, while the other receives a letter asking for explanations, simply because their sector's risk profile is different.
A graphic designer working from home who declares high expenses on computer equipment, for example, has a much easier justification to make than someone declaring the same amount of expenses in a business that, by its very nature, should have much lower operating costs. And this reinforces a point worth remembering. There's no magic number that guarantees you'll never be questioned. What exists is a probability-based reasoning, built on comparisons with thousands of other returns similar to yours, and the further yours strays from that expected pattern, the higher the chance that someone on the other end hits the review button. If you've already recognized some of these patterns so far, hang on, because the fourth red flag is even more unexpected, and it doesn't really have to do with the numbers on your tax return, but with what you show the world. The fourth red flag is a mismatch between the lifestyle you display and the income you declare. This point is fascinating because it completely steps outside the logic of just looking at the numbers on paper. HMRC also pays attention to external signals. Luxury cars, multiple properties, frequent expensive holidays, all of that can be cross-referenced against what's on your tax return. And don't assume this kind of information only comes from official sources like banks and registries. Very often, this type of discrepancy comes to light through third-party tip-offs or even social media. Yes, you heard that right. Posting a stream of photos from five-star resort holidays on your feed, or showing off a car that costs more than your entire declared annual income, while your tax return shows a modest income, is exactly the kind of contrast that can draw attention. HMRC will assess the credibility of the information before acting, of course, but even a vague tip can be enough to open an initial review of your records.
And here's an important aside. This isn't some conspiracy theory or excessive paranoia. It's simply the recognition that in a world where everyone documents their own life publicly, tax authorities have also learned to look for these clues. And that brings us to the fifth and final red flag, which is perhaps the simplest one of all to avoid, but also one of the most common in practice: recurring delays, frequent errors, and multiple amendments to your tax return. Think about the logic behind this. HMRC operates on strict deadlines, and a pattern of constant delays, or returns that get corrected over and over, signals to them a possible lack of organization, or, in more serious cases, an attempt to buy time or muddy the process.
This applies to self-assessment as much as it does to corporation tax, VAT, or payee. And what a lot of people don't know is that when an error is found in one area, say VAT, that can open the door for HMRC to investigate other areas of your tax affairs, like the corporation tax for that same business. It's basically a domino effect. A small issue, if not handled carefully, can turn into an entry point for a much broader review than you ever expected. And there's another interesting detail here. Businesses that have already been through an audit before and had some kind of adjustment made, even a small one with no intention of fraud, tend to be monitored more closely going forward. HMRC wants to confirm that the issues identified previously were actually fixed, not just ignored. Now, putting these 5 pieces together, it's easy to understand why HMRC has changed the way it operates so much in recent years. It's no longer waiting for you to make a mistake and finding out later. It's actively cross-referencing last tax year's digital platform data against the returns that have just been submitted this January. And this is only the beginning. The UK is also rolling out the OECD's Crypto Asset Reporting Framework, which means that starting in 2027, crypto exchanges will begin automatically reporting users' transactions to HMRC, just like international bank accounts already do. So if you currently think crypto is still some kind of invisible territory for the taxman, that window is closing fast. But I want to make one thing very clear before wrapping up this video. Nothing I've said here means you should panic just because you recognize yourself in one of these situations. Running a cash-based business isn't a crime. Having a loss in a new business isn't a crime. Posting a holiday photo isn't a crime. What really matters comes down to just one thing: consistency and documentation. If you can explain, with organized records, why your profit margin differs from the sector average, why your business had a loss this year, or where the money for that trip came from, you're protected, even if HMRC does knock on your door. The problem is never being questioned. The problem is not being able to answer.
And that's exactly where the reflection I want to leave you with today comes from. Most people only start getting their finances organized after they've already received that letter from HMRC in their inbox, when in reality, that organization should happen much earlier, quietly and consistently, as part of everyday life. It's not about hiding anything. It's about being ready to show everything at any moment without a scare. If this video helped you look at your own financial situation differently, drop a comment below on which of these 5 red flags caught your attention the most, because I'm sure at least one of them rang a bell. And if you want to understand even more about how the UK tax system works, without the jargon and without the complication, just stick around here on the channel, because that's exactly the kind of content we're going to keep bringing you every week.